Good morning, everyone. This is Brad Matheny. I thought I'd throw together a quick little video related really to traders and investors' concerns. I thought about titling this "They're All Wrong" or "They Don't Get It." And I'm just going to go into it and tell you what I see as taking place over the next, call it 24 plus months, given what I think is the likely outcome of what's happening throughout the world. So, we're going to talk about it briefly here. I'll put it here on this monthly chart. And it really comes down to this, guys. Okay. Um, the globe is resettling after COVID into a new structure. This includes decoupling of certain currencies, resettling of global economic expectations, reassess. Let's call it resolving risk factors and hedging, and essentially hard asset contraction. So, and I'll call this global hard asset contraction. So, what does this mean? I mean, really, what does this mean? It comes down to this: US recession, no. US, let's call it decoupling, yes. And that's going to translate into what I call vortex rally likely. And I'm going to explain this to you guys, okay? The global economy has been and was coupled to the US for quite some time. Now, I'm going to go back on this SPY chart as far as I can. But what I'm going to do is I'm going to highlight this, try to move this out of the way, and explain to you that, in 1994, 1993, 1994, I was working in Southeast Asia, down in Malaysia and Singapore in that area. And that was the time when the global currency crisis took place with the Asian currency market and George Soros. Some of you may have been around, some of you may not have been around trading during that time. But if you were around and you understood what was happening, was a decoupling of Asian currency took place related to um, uh, moderate parity to the U.S. dollar. And so let's do this. Let's take a look at USD to our, I think it's MY. So we'll come over here to Forex, and we're going to look for the Malaysian ringgit. Maybe it's MY. There it is. We'll see how far back this chart goes. It doesn't go all the way back. So in 1993, oh, it does. Okay. So back here in 1993, you can see that we had a moderate decoupling. Okay. This was the time frame right here that I was overseas in Malaysia, and we had a moderate decoupling. Doesn't look like much here, but in reality, this decoupling was rather dramatic. Okay. And it basically turned into a concern that when currencies decouple from stability, it presents a lot of risk factors to what is taking place in the global markets for central banks. And not only that, but for cross globe engagement, business activity, as well as commodity activity. There's a lot that goes on when currencies begin to decouple from a base value. And now what you're looking at here, this is a monthly chart. Okay, so we're looking at here 2015, 16, 17. You can see the growth to the upside here. And what's happened is just like in China, we've seen this growth take place. These normal standard deviation channels kind of come into play here. And so now we're looking at kind of a 3 year, 2 to 3 year standard of this upward channeling with kind of a standard deviation here. So when we start to move into decoupling to the downside, it becomes very dangerous when we start to see a 1 or 2x standard deviation range. In fact, let's just for the fun of it, let's get rid of these and pull up a standard deviation channel or a regression channel and really go from here to here. And let's go ahead and look at a 1% standard deviation channel, because this is where we start to see some real fun activity. This is the standard channel. And if we get outside of this range, this downward cycle channel, we start to look at decoupling. So let's take a look at the US dollar, Japanese yen. And again, we'll do the same thing. Here's a monthly chart. We'll start to take a look at, no, sorry guys, my Discord is going off. People are commenting about the SPY cycle pattern set up today. So here's our 1% standard deviation on the Japanese yen. You can see the longer term move here. And you can see that when we start to get into a decoupling, we're going to have a risk factor taking place. Now, we don't have a really broad decoupling yet, but understand that this move on a daily basis and or weekly basis has been moderately extensive. So when we take a look again at the decoupling, this is going back over a couple of years. You can see where we're at in this decoupling, that we're outside of the lower range. Okay, so we're getting a fairly aggressive downside move, indicating decoupling is taking place. Now let's take a look at USD EUR. Euro, US to euro. So here's a weekly chart again. We'll go back over the last couple of years. So basically from here, January to here. And there is our standard deviation channel. And we do not yet have decoupling. Okay, let's take a look at monthly. And if we go back a couple of years to these lows, 2014, up until now, we do not yet have decoupling. But I believe that decoupling will take place. I believe that's going to be the next big transition in the markets. And the reason why I believe this decoupling is going to take place, and it won't necessarily be in the euro or the Japanese yen, although it could devalue. I believe this decoupling is going to move global markets further away from moderate parity to the US dollar. And that's going to create concern related to global economics. It's going to create concern related to commodity price stabilization. It's going to be very disconcerting for the market related to a lot of factors. And that's going to be something that's going to drive market trends, particularly in the US. Like I said, I don't believe we're going to enter into a recession. I think the US dollar is going to stay fairly strong. I believe that the US economy is going to stay fairly strong. And I believe this, we're going to move back into a time where it's a little bit closer to, call it, the late 70s through 80s and early 90s, where the parity level of certain global currencies against the US dollar was much weaker, and there was a dollar dominance that took place for a period of time. At that time, it was maybe 15, 16, 20 years before China really started to rise and before Southeast Asia started turning into a real technology hub. That's when I was down in Malaysia when they opened up the I can't Putrajaya is what it was called, the technology center, the tax-free technology center. But it's a decoupling, and this decoupling is going to come really in the mode of, when we start to see the U.S. dollar. This is the U.S. dollar monthly chart, and you start to take a look from these levels here. Get rid of this again. You start to take a look from these levels up over to here. We're staying in a fairly solid upward trend. We need to stay within these channels, a 1% and or 2% channeling mode. The US dollar may continue to strengthen up into the 110, 114, maybe even 120 level again. And remember when I was, let's see how far back this goes. Yeah, here we go. So when I was overseas in Malaysia dealing with this, the US dollar had moved, from 80 up to 90 something. But the Malaysian ringgit collapsed, 23% in a matter of months. And that's a very big issue for what we see going on. And now you can see this 1983 was the peak of interest rates, the US dollar collapsing. I don't believe we've got peak interest rates yet. I don't believe we've got peak interest rates at all. In fact, if we come in here, Fed funds rate, and we go to economy. Okay, so let's call Fed funds. Let's find a Fed funds rate. I know it's here. I've used it before. There we go. So here we go all the way back to 2000. Oh, way back. Good. Perfect. So I believe that we're looking at a shift away from these lower interest rates into more moderate interest rates. And I think it's going to come kind of like this channel here. We've broken away from these channels. And it's because of the inflationary period that was brought on after COVID. And COVID really is the big disruption. Is again what I'm going to try to share with you. So we've got a very big disruption taking place that I think is going to lead to a speculative bubble in the US market. Now, let me show you this because this is very important. Let me find it. There it is. They'll get rid of the gold cycle patterns. Here we go. The market ratio index is essentially a measure of, how should I put this? It is a measure of expectations related to, let's call it US coupling or primarily US expectations related to um, uh, true valuation or speculative. So typically, when we see real valuation, like for example, we saw moderate real valuation increase in this area. It was very solid rally in this area, 2017, 18, 19. And the way that I can show you that we had, and these are part of my custom indexes, the way that I can show you that we had moderate valuation increase, meaning the stocks were perceived to be undervalued and were moving higher fairly aggressively, is right here. You can see in 2017, 18, 19, we had come into this base bottom. This was the low of 2018. Stocks were devaluing, expectations were weaker. Another one of my custom indexes. And then we moved into this valuation phase that lasted all the way up here past COVID and peaked at around May, June 2021 or 2020. And then we started moving weaker. And this is essentially overpriced stocks. It's showing us that expectations of a downward trend continued to weaken. But what did take place in 2021 and 2020 was that big expansion rally. And everybody remembers it. And that big expansion rally took place in the form of a speculative bubble. which was very clearly seen right here. Here's 2020. Here's a speculative bubble taking place. Even though stocks devalued, we had this big speculative bubble take place. So, what we're looking for in this manner, while we're rising over here and continue to try to rise, we're looking at a potential speculative phase, a real kind of decoupling. And this was a decoupling in the sense that the global markets had put so much stimulus into the market, and the stocks had been fairly undervalued. Everybody had extra money, so this was a call it an excess capital speculative bubble. Now we're moving into a decoupling speculative bubble, and the decoupling is coming in the form of not only the actual valuations starting to move higher again, which means that we're starting to get real growth, but we couple that with the market trend index, and we couple that with the fact that the global markets are starting to collapse, and we couple that with the fact that gold is starting to make a very strong appreciative move here. I believe what we're looking at is a true decoupling event where global economies will decouple away from the US economy in moderate form. Some may be 10, 15, 20%, some may be more, but it's going to be a decoupling event that reverberates across the globe in the sense that we are moving into a stronger US market, which is going to present, and this is a weekly SPY chart again. Let it load. There's my content. We're going to move into this decoupling phase, which I believe is going to send the US markets into a very, very strong upward, what I call vortex rally. I'll shrink these. These are some of the new Pine script tools I've been working on. Very cool little tools, I think, but we'll see once everybody gets their hands on them. And give you an example. These little green triggers are what I call gunslinger triggers. And then these areas, which I'm still working on, are the exhaustion triggers. So you can see we've got trending defined here, intermediate long-term trending. This is a monthly chart. Very clear bullish trending initiates back over here. Bollinger Band bullish trending initiates over here. We get a lot of what are called gunslinger entry triggers here, these green triggers. We move into overbought scenario here. We move back into gunslinger mode here and here, meaning buy, buy, buy. Into overbought mode, meaning pull profits, trail stops. We move back into gunslinger mode here towards the end of this. Then we get into overbought again. No real gunslinger mode through here. Got a couple of gunslinger triggers over here, but we've stayed long the entire time. Now, little rotation right here. Okay, this would have moved us into short trading potentially. We had no new triggers. This was monthly. We went right back into long gunslinger mode, stayed long here through the Bollinger Bands, and now we're up, what, 22%. But what I was trying to show you was the real reality of the Vortex rally is that the US markets start to accumulate wealth, foreign wealth. And the question is, where are they going to put their money for safety and security? If currencies decouple and hedge assets like gold, silver will continue to move, where will global traders put their money for safety and security? And my bet is we're going to watch a vortex rally take place very quickly to where the SPY could double or triple over the next call it 5, 6 years. And a lot of people don't understand this, but this is the basis for a lot of my analysis. Recession, I mean, maybe a soft landing transition, but not a real recession. Are we going to run into some stagflation? Yes, we are going to have some stagflation. But this decoupling process is likely going to move us into a vortex rally. And that vortex rally is going to be very powerful, extremely powerful when you consider the amount of capital, because the world capital, global capital, will continue to function. It doesn't just go away. It stays and operates and seeks out the safest, most secure environment for return on investment while avoiding risk and eliminating risk, or essentially settling, which I mentioned up here. Resettling global exponential, resolving risk factors, and hedging. So, this is a hint, guys. The next 6 or 7 years are going to be the biggest. Next 6 to 7 plus years will be the biggest opportunity of your life. And I want you to be aware of that. Okay. This is no joke. You're going to hear a lot of people call crash, 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 crash. You're going to hear a lot of people talk about how, oh, this or that, or you don't understand, or we've got to deal with our debt. Well, you know what, guys? Let's go back here. Well, I'll do it in another video. But remember what happened after World War II? Did we eliminate our debt after World War II? Nope, we sure did not. You know what got us into a healthy environment? We grew out of our debt. So imagine I rack up $100,000 in debt, but I only have $80,000 in income. What do I do? Well, if in 5 years I can grow my income to $400,000 and keep my debt relatively minor to 120, 130,000, now my debt to GDP ratio is only 26% instead of 108%. And that's exactly what happened after World War II. And I believe that's going to be exactly what happens over the next 6, 7 years. You're going to watch the US market climb. You're going to watch global markets decouple. So while the US market does this, global markets will likely do this. They will decouple from the US market. You're not going to see the same parity in relationship to growth. And that's going to set up a scenario where we will grow our way out of the risk factors that are taking place right now. You just need to be aware of it. Okay, guys, that's it for now.